Good afternoon, everybody, and welcome to Scope's Outlook for the European Bank and Corporate Hybrids. With me today is Azar Shamem, Corporate Finance Analyst at our rating agency, who's also the author of a recent report on corporate hybrids. And then I have Pauline Lambert, an analyst in our Financial Institutions Group, who also publishes regularly on bank hybrids and most recently her quarterly AT1 summary. That's also available for download here on the right-hand side of the screen at the bottom under the apps button. My name is Dirk Brandenberg. I'm Scope's head of ESG and credit research, and I will guide you through the meeting today. It's quite unusual, the format here, because we're dealing with both corporate and bank hybrids in this call. I know they catered quite a different investor base, but we thought it would be useful to juxtapose a little bit the issues here that have affected both markets in 2022 and then our outlook for 2023. To introduce the subjects, just a brief overview of what assets we are talking about here. As you can see, corporate and bank hybrids together represent about 400 billion worth of outstanding debt in Europe, and pretty much split evenly between corporate and bank hybrids. And you can see on the left-hand side, corporate hybrids very much dominated by the utility, telco, and consumer sectors, which are more sort of the stable credit profiles, and then also some cyclical issues out of real estate and energy. On the right-hand side, you can see the breakdown of the bank AT1 market. Here you can see that Euro area banks clearly dominate this market, but you can also see that the UK, Switzerland, and the Nordic countries also play an important role here, and these are not part of the European Union or the Euro area. So quite a differentiated picture here as well in terms of issuance. Like many credit assets, hybrids had a very difficult time in 2022, which you can see here on the left-hand side, the spreads for bank hybrids, which is the blue line on the left, and then on the right-hand side, you can see the performance of corporate hybrids. So clearly they underperformed, but we can also see that since the beginning of this year, those assets have actually, in line with the overall market, but also outperforming the overall market, at least in the bank space, have performed reasonably well again. What's the main factor here? Well, my colleagues will talk you through this, but bottom line is there are two areas here. One is clearly the underlying fundamentals and the pressure that credit fundamentals were on generally in the various corporate sectors and then also in the bank sector. But then also a big premium here, and this has been one of the primary concerns for investors last year, the fact that these are perpetual securities, which means issuers can or cannot refinance them in extremis. And clearly with rising yields, one of the big questions is, will issuers refinance these deals and why? Going to the next page, you can see corporate hybrid issuance in 2022 came almost to a standstill in the second and third quarter, rebounded a bit in the fourth quarter, and then really came back forcefully in the first month of 2023. So what you see here is basically 1 month of issuance. So there's still 2 more to go. So this could pick up potentially. And then on the right-hand side, you can see AT1, a bit more steady in the issuance profile, but also clearly lower than in previous years. Again, not surprising in a difficult bond market environment. What's been driving this issuance primarily is the upcoming call dates these issuers face. Here you can see the schedule from 2023 onwards. On the left for the corporate hybrids, and then on the right for bank AT1s. And this is, in the end, a pretty relentless schedule that forces corporates and banks continually to decide how to refinance these deals, or indeed, which is one of the risks we're going to discuss today, not refinance them because of the yield pressures they're under. With that, I hand it over to Azar Shamem to talk us through her views on the corporate hybrid market.
Thank you, Dirk. So first of all, I wanted to briefly define what is a hybrid bond. So a hybrid bond is a contractually subordinated bond that carry debt and equity features. That's why it's called the hybrid. Basically, the equity-like features are the coupon deferrability and long maturity. And Scope assigns 50% of equity credit to a hybrid bond as long as it meets certain criteria or the features that are illustrated here in the left. So basically, the hybrid bonds are appealing to issuers due to these equity features, which support somehow the issuer credit rating, but also investors are attracted by the extra yield that this debt instrument has due to its subordination. So looking at the issuance volume back in the previous years and back in 2018, there was a low interest rate environment and ultra loose monetary policy, which attracted a lot of issuers and increased the attractiveness of the hybrid bond market, which was before that exclusive to only investment grade issuers or frequent issuers from the utilities or telecom companies. But then a lot of new issuers tapped this market, and we saw a record issuance, especially in the pandemic year, as a lot of companies were seeking to strengthen their liquidity. However, in 2022, the issuance volumes that was successful in 2020 and 2021 saw a steep drop in issuance driven by unfavorable and volatile market condition where the spreads widened massively. So looking at 2023, which is important to us now as we look today, we see that we expect some activities in the hybrid bond market, incentivized primarily by the first call date. So we expect somehow an issuance volume of 15 billion to more than 15 billion, as there are more than 50 billion of first call date falling due in 2023 and 2024. So the question now that a lot of issuers are facing is whether to call or not call. Some issuers will be tempted to skip the initial call because the step-up coupon is below the cost of replacement. This may disappoint, of course, investors who may demand a higher premium in the future if these issuers will seek to issue a new hybrid in the future, reflecting somehow the extension risk. We also expect especially frequent issuers to tap the hybrid bond market as they pay extra attention to the factor reputational risk and wants to show the commitment to the hybrid capital as a permanent part of the capital structure because they seek the 50% of equity issuance that the rating agencies assign to them. As of today, so we have 5 billion of issuance that were mostly in January. Most of them were from the utility sectors, and mostly was for the purpose of refinancing. And we will see how will the next month goes.
Yeah, thank you, Azhar. We'll certainly come back on the motivations here of companies to issue or not to issue. Before we do that, I want to hand it over to Pauline, just to give us the banking perspective. What's been driving bank hybrids, in her opinion, and what's the way forward here? Pauline, you want to take over, please?
Thank you, Dirk. Let's see. So a little bit similar to corporates in the sense that bank hybrids play an important role in the capital structures of banks. But here, banks are motivated because hybrids can be used to meet their regulatory capital requirements. So what we saw was that during the Great Financial Crisis, there were weaknesses in the capital bases of banks, and banks had to be bailed out. So consequently, reforms came into place to improve the quality and the quantity of bank capital. So what we had was the introduction of a new framework to classify regulatory capital, and also the introduction of the concept of going concern and gone concern capital. So the idea is that regulatory capital should be focused on high quality capital. So primarily in the form of common shares, retained earnings that can absorb losses. Banks do have the option of meeting their requirements with also hybrid securities, A2 1s and Tier 2 securities. But in all cases, all of these capital instruments must be able to absorb losses when a bank has reached the point of non-viability and before taxpayers are actually subject to losses. So today we're looking at the AT1 securities, the hybrid securities. That's our focus today. And I would say that these securities currently face increased extension risk due to the current market environment and as well due to their structures. So they are perpetual securities, but they're usually structured of a call after 5 years. And if the securities are not called, the coupon is reset. And historically, the market has priced these securities to the call date and largely assumed that investors would call the securities. But in the current environment, this is no longer a given. So what we see are that the coupon resets are actually potentially more economical than refinancing. So issuers actually have to consider various factors in making their call decisions. Certainly, what are the economics? What is the market like? And also their relationship with their investors. So these are all considerations. And also to complicate matters, actually, with AT1 securities, banks actually need regulatory approval before they can call their securities. Let's see. I was going to say that in terms of, I guess, being available to meet the requirements, so AT1s certainly play a role, but I would say a limited role. Because as you can see from this chart, banks are subject to various requirements. We can think about them as the minimum requirements that apply to all banks, requirements that are specific to a bank, and then on top of that, capital buffers. Now, AT1 securities can be used to meet both Pillar 1 and Pillar 2 requirements, but only a part of that. And if we look at that combination of those requirements, AT1s can meet approximately a little bit less than 20% of those requirements. So given the fact that these requirements have been in place for quite a long time, and banks have been able to issue AT1 securities to optimize their capital structures, we don't see the market growing a lot. We do expect issuance to be driven primarily by refinancing needs. So the other component or structural feature of these securities, of course, is that the coupons on AT1 securities must be discretionary, and they're also non-cumulative. So if a bank doesn't meet its requirements, in this case, it's Pillar 1, Pillar 2 requirements, as well as buffers, a bank will have to calculate the maximum distributable amount, or what we call the MDA. And this will then determine how much a bank can pay out in terms of AT1 coupons, dividends, and variable remuneration. So as you can see, this MDA threshold is quite high for banks, and this will drive, whether coupons can be paid or not. Now, historically, the market has looked at risk-based capital requirements because this will determine whether an issuer can pay their coupons or not. But actually, since the beginning of this year, we have a new requirement that has come into place, which is the leverage ratio buffer requirement, which is impacting global systemically important banks in the EU, the ones that you have here. And they are subject to the minimum 3% leverage requirement, but on top of that, also to a leverage ratio buffer. And this buffer is equal to 50% of their GSIB buffer. So now banks have to meet these two leverage requirements. And if they breach these requirements, again, they would have to calculate the MDA. So another reason where they may not be able to pay their AT1 coupons. And then I would also point to the fact that since the beginning of last year, EU banks have been subject to another requirement, which is called MREL, which stands for the minimum requirement for own funds and eligible liabilities. Now, the purpose of MREL is to ensure that actually creditors as well as shareholders, can contribute to the loss absorption and recapitalization of a failing bank. So if a bank fails, investors are there to support this process rather than just taxpayers. So again, in this case, if a bank does not meet its MREL requirements, Here you see the MDA is calculated, and therefore this can also impact an ability of an issuer to pay their coupons. Now, in the case of the MREL MDA, there is one distinction in the fact that the restrictions on coupon payments are not automatic. So what happens is that the issuer must notify the resolution authority, and then over a period of 9 months, the resolution authority will assess, why is the issuer in breach of its requirements, and what is the magnitude of this breach. And after the period of 9 months, it will take a decision about whether to exercise its MDA power or not. And it will consider things like, is the issuer in breach because market conditions have been difficult and they haven't been able to issue, or to be able to issue at an economic rate. They will also consider if they exercise their power, could this potentially have spillover effects and impact the rest of the banking sector? So not an automatic restriction on coupon payments, but something that's a bit more, I would say, based on discretion from the supervisors. So in light of the various requirements that banks must meet in order to be able to pay their AT1 coupons, it's important for investors to focus on those issuers that can generate capital on a consistent basis and have good access to capital markets. And with that, I would like to hand it back over to Dirk for Q&A.
Thank you, Pauline. And I have actually a very quick follow-up for you here. What is it actually we rate when we assign ratings to bank hybrids? Do we rate the payment of coupon, the payment of principal? How does that work?
Well, due to the nature of the securities, missing a coupon is not considered a default. So certainly, if an issuer did not pay a coupon or was prevented from not paying a coupon, we would have to look at why this has happened. Is it a sign that there's something fundamentally wrong with the issuer and that its earnings capabilities going forward have been impaired? And if this were, a permanent impairment, we would have to adjust our issuer rating on the issuer. And, we would think about, then how that impacts the rating on the AT1 security according to our methodology.
Okay, no, thanks for clarifying that. And Azza, how does it work with corporate hybrids? Does skipping a coupon present an event of default?
No, not really. So there is this flexibility that the hybrid bond offer, which is to defer the coupon payment. And for us, this is a legitimate thing that issuers can do because this comes with the issuance of a hybrid. So, however, it comes also with a price because deferring the coupon is not as simple as it looks like. It comes also with dividend pushers. So the day when the companies decide to defer its coupon payment, it's you can read it in the prospectus of some bond hybrid prospectus that you cannot also pay dividends. So it's not that easy. But for us, it's not considered as a default. So it's just a legitimate act that some companies do, and we experienced such thing a few years ago when Lufthansa had to not pay the coupon on its hybrid bond due to the state support that it received. So it's completely legitimate and part of the flexibility that the hybrid bond offers.
Thank you, Azza. And maybe also just back to Pauline on this one, the covenants that protect bondholders. I think Azza outlined that dividend pushers and stoppers are quite an important incentive for companies to service their debt. The question for banks is, I guess the protections are less, and yet the exposure, as you pointed out, to earnings volatility of AT1 coupons is reasonably high. How should people view the investor protections on AT1?
I think the protections actually go back to the fundamentals of banks themselves. So banks are very highly regulated entities, and there are plenty of protections to ensure that banks remain sound and that they don't go into insolvency. So there's a lot of protections around the issuers themselves, But actually, as an AT1 investor, you're expected to be there to take losses. So, you're supposed to be able to take a hit to coupons. You're supposed to be able to, be written down or converted if an issuer's CET1 capital ratio is below a certain level. So certainly the protections are not there, but for the AT1 investors, but the issuers themselves are, I guess, protected in some ways, to ensure that they remain sound entities.
Yeah. So
Maybe
sorry,
Sorry,
Azza,
yeah.
please go ahead.
Maybe back to the corporate. So when you talk about investor covenant, there is something that is important. So the day where the issuer decide to not call the hybrid on the first call date, this hybrid lose 50% of the equity that like scope assigned to them. So it's the 50% of equity, they lose it the day when they decide to not treat this hybrid as along with this equity feature. So this is very important. And also the fact that the issuer will be penalized with the coupon step up once they decide to not call on the first call date. So they need to deal with the consequence and paying a higher coupon in the upcoming years. That is reset every 5 years based on the formula that is somehow very expensive for some issuers.
Yes, I think that is an important point, that corporates have an incentive to refinance and access the hybrid market to protect their credit ratings. Banks have an incentive because if they don't fill their buffer with AT1, they would have to fill it with more expensive capital instruments. And again, so there is a certain degree of devotion here to ongoing capital market access for these instruments, regardless of the interest rate environment. So I think that's, I would say, a pretty important takeaway from what you outlined here today. I just want to take it back to the performance or the spreads that we observed for hybrids in 2022, and then I guess the sort of better picture we had in the last couple of weeks. So I think, Pauline, you already outlined there's clearly exposure to earnings here, but at the same time, we know that banks had a pretty good year in 2022, and also with rising rates, the forecast for 2023 don't look that bad, and the share buyback programs are being scaled up from what I can see. So looking at that, it's probably fair to conclude that the performance of hybrid was less driven by earnings concerns or capital concerns, but seems to be mainly about the refinancing risk and the reset of coupons. So can you just give us, in a nutshell, your thoughts about what you think, how big is this extension risk that people face on these instruments, and how they should think about that?
Well, certainly, I think there is still extension risk due to what's happening in the market. The rates are high, the markets are volatile. So what we have seen is that some issuers have actually not called on their first call date, either because the market was potentially closed or the levels were unattractive. So, but they did then call and refinance at a second call date. And, this happened to be 3 months later. So, this was certainly something that was possible, and we have seen that. But I think investors need to be aware that depending on the structure of the AT1 securities, that second call date, it could be in 3 months, it could be in 6 months, it could be in a year, and sometimes even in 5 years. So it's not a given. And certainly, I think that it's a way to, certainly that needs to be assessed, when thinking about extension risks of AT1s.
Okay, thank you, Pauline. And then maybe going over to corporate hybrids. I mean, we can see here the performance. These are yields, by the way, not spreads, but it gives you the story here. Clearly, the credit profile here is much more diverse as with banks, so there may be credit factors. But again, I suspect that during 2022, refinancing costs was sort of the main driver of hybrid performance here in the corporate sector. Azza, what are your thoughts? How should people think about extension risk going forward?
It's an important factor. So the spreads are moving according to the concerns of investors and also issuers. There are some concerns about extension risk, but also deferrability risk. So the hybrid bond market is more sensitive than the normal or conventional bond market due to the subordination. So it has an extra risk that brings the concern. So before the 2022, the spreads difference between a hybrid bond and a regular bond has been relatively slim. That's why a lot of issuers were encouraged to tap the hybrid bond market, or investors wanted to get the extra yield that the hybrid bond was offering. However, now the spread widened, so before investing, they need to think about it. But as I said during the presentation of the volume, now the hybrid bond market matured a lot. There is an outstanding amount of issuance there, so we will see further issuance. Of course, this year, in terms of visibility, we have further visibility, and also companies adapt to the new environment, that we will not see anymore the very low interest rate that we used to see in the previous year with the tightening monetary policy. So just frequent issuers or companies that can bear with the consequence of having to pay a higher coupon will tap the market. But last year was really difficult, but I think this year we will see more visibility and more constant in the hybrid market, as was shown in the first month.
Okay, well, thank you for that. Maybe back to Pauline. You talked a lot about the sensitivity of AT1s to profitability of banks, famous MDA threshold. But yet there is an ongoing debate out there that, in fact, while all these structures allow for these deferrals, they tend to be used, well, never been used. Don't quote me on that, but put it very rarely being used outside of a default. So the question really is, how effective are these instruments in terms of actually absorbing losses, and what is the risk that one day a regulator comes in and says, well, actually, that's not what we expected to happen. We need more participation in going concern losses, and start off a debate about the suitability of these instruments as regulatory capital. How should we be looking at that debate?
Yes. Well, certainly on the point of coupons, banks are very aware that there is this MDA threshold, and they work very hard to stay above this threshold. And despite the fact that the coupons are really discretionary, supposed to be discretionary, banks have been quite hesitant to use that option. Clearly, it can have implications for their reputation. They're not sure what the market reaction is going to be. So, skipping a coupon, even though it's allowed, has not been done really. I think the other aspect of AT1 structures is the fact that, there is a trigger for write down or conversion into equity, but it is set at such a level where the CET1 capital ratio goes below 5.125%, or in some cases below 7%. Now, these are still actually very low levels, because when we look at the requirements that banks must hold these days, they're closer to around 10%. So it is quite unlikely that, a bank will actually breach this level and hit the trigger. So these are certainly concerns that the regulators and supervisors have. And there have been studies done to evaluate the effectiveness. I think the conclusion is that, there are certainly some question marks, but at the same time, I don't think there's a strong will to reform the requirements around AT1 securities. Supervisors are now working on, implementing the final reforms to Basel III. So I think this is the focus. There's a lot of other regulatory requirements that are coming into place that regulators are focused on. So, this is something that is in place, seems to be working. The market has gotten used to it. and it's an important part of banks' capital structures. There's market support behind them. So it's unlikely that changes are going to be happening in the near future, although it's something that's always sort of in the back of the mind, I guess, for regulators.
So essentially, yeah, Bank AT1 investor, bank hybrid investors, they benefit from very sort of deep out of the money optionality there on part of the issuers. Maybe that is one of the explanations why they have performed so well. I don't know, recently, other corporate hybrids, they still seem to be lagging. So what is your explanation for that?
Yeah, again, my explanation is due to the fact that they are highly somehow correlated to the equity markets. We see this uncomfort that the market is feeling due to they are concerned about inflation, concerned about the next step that the ECB will take, and this subordination of the hybrid bond make it more risky than any other. That's why it's really, of course, it recovered if you compare it to 2022, but now it's just normal that you see it. There are some concerns, and this is the explanation. This is explained that shown reflected in the high spreads that we are seeing, or yields.
Okay, great. Well, thank you very much for that, Azar. So we're on the half hour. So first of all, I have to thank the audience for being with us today. And as I pointed out, downloads are available at the bottom of your screen under the apps button. Replay will be available and distributed soon after this recording ends. And with that, I would like to close this call today. Many thanks to Pauline and Azar, and hope to see you all very soon. Thank you. Bye-bye.
Thank you, John.